Welcome everyone to Vested Interest. Hey, hope you had a great week. This is Shane. Just wanted to touch base on another video, update you on what stocks I picked up for this week. Guys, I hope you had a great week. I know it's volatile out there in the markets, up one day, down 3, 4, 500 points the next. I think the most important thing to remember in times like this is to look at your portfolio, find those stocks that you have high conviction in, that you've done the research on, that you know are good companies, that have good earnings, that are going to be around for the long haul. Look for those deals, and then to continue to dollar cost average into those positions. Decreased your cost basis, increased your yield. I prefer dividend growth stocks. If you guys are into that type of content, I will give you an update weekly on what I'm purchasing, where I think I see value, and where I see value, I'm going to actually pick up shares of those companies along the way. I am in the accumulation phase, so I am pretty aggressive whenever I see the dips. As you'll see in this video, I put some money to work in the portfolio on 3 separate days. Guys, so without further delay, let's get right to the video and you can see what I picked up. And let me know what you guys think of the video at the end. Here we go. So on February 8th, I put $2,215.64 to work. We picked up, these are always in reverse order, 10 shares of Store Capital. That is a REIT, and I picked those up for $30.27 per share. I picked up 10 shares of Intel Corp. That is in the technology sector at $48.05. I believe anything under 50 for Intel is a great price, and I actually love what they are doing currently. The investments they've made in Ohio, their new factory in Ohio, I think it's about a $20 billion factory they're going to be building there. So I love them bringing some of that manufacturing back here to the States. And again, anything under 48 or anything around $50 or lower, in my opinion, for Intel is a steal. Omega Healthcare Investors, I picked up 10 shares there at $27.40. This is a very high yielding dividend stock, guys. I think it's around 8% now, as it's pulled back a little. And they invest in elderly homes, right? So your retirement type homes for people who are sick and that sort of thing. So this one I think is also a good play for our elderly population as the baby boomers are retiring and entering that phase where they're going to need to be in the homes where they need to be cared for. And I would say over the next 10 to 20 years, that's going to be the case. So this one is a long-term play, not only for the high yield with the higher inflation rates we have right now, but also for just the nature of our population and aging population base. I picked up 10 shares of Kraft Heinz at $34.66. This one is pulled back quite a bit, and all these are below my cost basis. Intel is pulled back, Store Capital is pulled back, Omega Healthcare is pulled back, Kraft Heinz pulled back. That's what I look for, guys. When they pull back, I like to pick them up at what I consider a discount. So 10 shares of Kraft Heinz, ticker KHC, at $34.66. I picked up 10 shares of Leggett & Platt, ticker LEG. And I'm sorry, Kraft Heinz is a consumer staple, and Leggett & Platt is a consumer discretionary. I picked up Leggett & Platt at $39.38. Leggett & Platt I've been adding to for quite a while now. They are pulled back significantly, so I consider them a real good value right now. I picked up 2 shares of 3M, ticker MMM, at $160.98 per share. 3M is in the industrial sector. And I added to had a little bit of money left over, so I added to my AT&T position, ticker T, 4 shares at $24.05. So that's what we picked up the first day on Tuesday, February the 8th. We went back to work on February the 10th and picked up some more shares. We put $802.61 into the portfolio. And with those funds, we picked up 1 share of Johnson & Johnson, ticker JNJ, at $169.84. Johnson & Johnson is in the healthcare sector. We picked up 1 share of Huntington Ingalls Industry, ticker HII, at $181.62 per share. Huntington Ingalls Industry is in the it's in the same sector as 3M in the industrial sector, but it is a defense contractor. We added again to 3M, ticker MMM, at $162.10 per share, one more share of 3M, again in the industrial sector. We picked up 4 shares of Verizon, ticker VZ, at $53 per share. Verizon is in the communication sector. And we picked up 7 shares with a little bit of funds we had left over of Lumen Technologies, ticker LUMN. Lumen Technologies is another high yielding in the communication sector, but a little higher yielding. I think they're around 6% dividend yield. So nice yielder there, and they did miss earnings, so they had a little bit of pullback. I think they're actually around $10 per share now, so they have had even a little pullback beyond the $11 where I picked them up here. And then on Friday, February 11th, we went back in through $792.67 into the portfolio, right back to Omega Healthcare Investors, ticker OHI. We picked up 10 more shares at $28.86. 10 more shares of Store Cap, and that's a REIT, and 10 more shares of Store Capital. Again, Store Capital is pulled back $30.22, picked up 10 more shares there, ticker STOR. And 4 more shares of Intel Corporation, dipped below 48 where we picked it up earlier in the week at $47.95, so we picked up 4 more shares there. And we added 1 more share of Lumen Technologies with a little bit of funds we had left over. Lumen Technologies, again, is in the communication sector, ticker LUMN. And again, like I said, 1014. So we picked it up earlier in the week at $11. It dipped down even further, $10.14. So you can see whenever I say I like to dollar cost average as these pull back, that's exactly what you're seeing here, guys. At $48, I was picking up Intel earlier in the week, so I'm going to pick it up at 47 to continue to decrease that cost basis, increase the yield, and I've set my price for Intel at $55. If it goes up above $55, I probably won't add significantly to it. But if my cost basis is low enough, now if I'm around $46, and let's say it goes up to $57, I will continue to add to it until my cost basis hits that $55 range that I've set. So I know a lot of people will set a price and they'll say, I'm never buying over that price. Well, I don't necessarily agree with that, because if my cost basis is low enough, I can actually go over the price that I've set so long as my cost basis doesn't go over that cost. For example, CVS is one I'm looking at, and it's gone up significantly from where I bought it. My cost basis for CVS is $79 per share. It's currently at about $105 per share, which is a little over what I want to pay for. But if I was to pick up, more shares, it'll take that $79 up to 80, 81, 82. And so long as I'm not paying above that $105 I feel is fair value, I'm fine with picking it up a little over what I believe is fair value, so long as my cost basis stays low enough, if that makes sense. Hope that makes sense. Now let's look at a quick review of the overall portfolio, guys. Currently, the total value of the portfolio is sitting at $83,568.58. We are creeping up on that $100,000 portfolio range. I have about 50 positions in the portfolio. I'm trying to get quite a few of them to around 100 shares or more. That's kind of a goal of mine for several of those positions. Intel's being one of them, KHC, Leggett and Plaid, all the ones that you've seen here. I'd like to get up to $100 a share. We're starting to get there. And the dividend yield, guys, has crept up to 4.469. I think we were about 4.3 last time we were there. I'm trying to get, for the year, my goal is to be over 5% dividend yield. So I am watching some of the higher yielding companies like Lumen Technologies, like Store, like the Omega Healthcare REITs to bring that yield up. Again, with inflation running a little hot, I want to make sure I'm not losing purchasing power and get my yield up a little bit. And then obviously the most important part, guys, what we're really after with a dividend growth portfolio is that passive income in the form of dividends. Last week we were around $3,500 annually in dividend income. We are up now to $3,734.78, and that's what it's about, guys. Eventually we will be bringing in enough annual dividend income to retire, to utilize the portfolio to reach financial freedom, and that's what dividend growth portfolios are all about. We'll never have to sell the shares. We continue to take in those dividends, paying us monthly, annually, and living off those dividends eventually. Guys, if you like this kind of content, if you're interested in seeing a portfolio actually grow and what I'm purchasing on a weekly basis, not just talking about the stocks out there, then I ask you to join the channel, like the video if you like it, thumbs down if you didn't like it, share the content with anyone you think might enjoy the videos, drop a comment, let me know what you think, and consider subscribing to the channel. Come and join me on this journey. Let me know what you guys are doing in your portfolios. Are you sitting on the sidelines? I know there are some people who have sold their entire portfolio. I definitely do not recommend that, guys. Sit tight, if anything. If you're going to sit on the sidelines, maybe stack up your cash and wait for those dips. But have an idea of the companies that you want to invest in. Understand the companies that you do want to invest in. Are they, profitable? Make sure they're profitable. Understand their debt ratios, their free cash flow. Make sure that they can cover the dividends if you're investing in dividend companies. I prefer companies in the 70% payout ratio or lower if they're paying dividends. There may be REITs, for example, pay in the 90% range, but that's a law. They actually have to pay out 90% of their profits by law, so I don't mind them being a little over what they typically would be for other companies because they have to. Guys, real quick, we'll run through the portfolio allocations. Another thing that I think is very important is to be diversified. As you can see here, communication sector at 8.88%, consumer discretionary, my lowest pie at 2.77%, and that's for a reason. Right now, I believe we are entering a little bit of a pullback in the economy. We may enter a recession, and consumer discretionary does get hit pretty hard in those times, so I have kept this portion of the pie relatively lower than I typically would actually, and I am watching several in this sector. Whirlpool for one, Target I'd love to jump into, Home Depot, but I just still feel like those particular companies are vastly overpriced, so I'll wait for them to pull back into fair value, what I consider fair value. Consumer staples, always a good sector. You're going to buy things that you have to buy, food, shampoo, toothpaste, that sort of thing in the consumer staple sector. Typically does good in good times, obviously, and in bad times. Energy sector at 11.8% for consumer staples, 11.57% for energy. Energy is another one. We all have to heat our houses, cool our houses in the summer, and we like to have lights on. So energy is another one I feel like is good to have allocated in your portfolio for any time, good times, bad times, especially in bad times. People will stop buying stuff in the consumer discretionary sector, but they won't necessarily cut back in energy. Like I said, we've got to heat our house, got to keep it cool in the summer, and most people like their lights on. Financials at 8.72%. Healthcare, again, this is one that I don't mind in the 11, 12, 13, even higher percent. I'd run this up to 15% and not feel too bad about it. We do have an aging population with the baby boomers, so it's one that I believe is going to be funded significantly over, again, the next 10, 20 years. Industrials is 11.4%. As you saw on the portfolio, I'm adding to this. 3M is one I'm adding to heavily as it dips back down. I think my cost basis is at around 169 per share. It's down around 160, 162. So I'll continue to add that as it pulls back. Huntington Ingalls Industries was another one that I'm adding significantly right now as it pulls back. Technology is at 8.73. You saw Intel. I don't mind the technology sector. You do have the NASDAQ, which has had a significant pullback. A lot of companies in this sector were vastly overpriced. So you are seeing a big pullback in a lot of those companies that weren't producing profits, and that's the reason they're pulling back now that it looks like, well, it doesn't look like the Fed has said they're going to start raising rates. Companies that do not have profits will get hit the hardest whenever they raise rates because they count on being able to borrow money at cheap interest rates. And when they can't borrow money at cheap interest rates, those future profits that they were counting on or thinking they were going to materialize just aren't going to be there, guys. Don't fool yourselves. Don't kid yourselves. If you go back and look at the dot-com crash, I mean, there's companies like Microsoft, for example, which is one of the ones that made it through the dot-com crash and is still around. Intel, another one. But if you go back and look, guys, they hit really high. Intel, for example, was in the $70 per share range. It's never gotten back there. Microsoft took 16, 17 years to get back to fair value before it started to increase in value again. And again, these are the companies that actually made it through the dot-com crash, most of the companies, I think it's somewhere of 80 to 90% of the companies went bankrupt. So you can indeed lose every dime that you've put into some of these companies thinking that they're going to continue to grow 40, 50%. It's just not going to happen. And I hope that you realize that, and I hope you understand the companies you're actually in and that they are producing profits. Profits do matter, debt does matter, and companies that don't produce profits are the ones who are in serious trouble whenever the economy pulls back. Whenever you have recession, whenever you have depressions, those companies will get hurt the most if they make it through it all. Then we have the material sector at 6.51%. Utilities is just like energy. You know, it's the electric, the gas, the oil that we need. And then we have REITs and real estates at 11.62. I am looking at some ETFs in the foreign sector, but that will probably be around the March timeframe that I'll look to add some of those whenever I get my wife and I get our bonuses around then, and I'll look to add a significant amount to the portfolio, you know, probably $10,000 to $30,000 range at that time, and I'll probably pick up some ETFs and some emerging markets and some foreign markets as well. Well, guys, that's it for the video. I appreciate you stopping by. Like I said, drop a comment below. Let me know what you're doing in your portfolios. I'd love to hear it. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial securities come to those who take a vested interest. Hey, we'll see you in the next one, guys. Thanks for stopping by. Hey, enjoy the Super Bowl and go Rams. I am not a financial advisor. Nothing in this presentation should be considered financial advice. I am only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can lose money and should never invest any amount you are not comfortable losing. Always do your own research and invest based on your situation, circumstances, and selected criteria, or seek the advice and counsel of a certified financial advisor.